Right then, let's jump straight in. Morgan, my man.
Good to have you.
You too, Chris. Let's get to it. We're talking about the big leagues today.
Yeah.
The stuff that trips everyone up. You get these guys staring at one stock chart, yeah? Praying to the chart gods. But the real game, the smart money game, is seeing how everything connects. We're talking equities, commodities, bonds, and FX.
The lot.
The whole shebang. This is proper CMT level 2 thinking, you know.
Mate, it's everything. If you're only looking at stocks,
Right.
you're basically driving while looking in the rearview mirror. It's the last thing to move. The real story is told by the other three. I call them the crew.
Okay.
You got bonds, who are the brains. You got commodities, the muscle. And you got the dollar, who's the big boss. Stocks are just the flashy, loudmouth face of the operation.
The face of the operation. I like that. All right, let's start with the classic face-off then.
Yeah.
The face versus the brains. Stocks versus bonds. The textbook says they move opposite to each other when people are bricking it, when they sell stocks and buy safe bonds. Is it still that simple?
The core logic is still solid. It's about risk.
Right.
Scared money flows to safety. But the why is more important. The bond market is a beast. It's sniffing out economic trouble or strength way before the stock market does. Think of the bond market as the grizzled old detective who's seen it all.
Okay.
And the stock market as the rookie cop running in with sirens blaring after the fact.
So if the detective, the bond market, starts quietly packing his bags,
Yeah.
is it a signal?
It's the biggest signal you can get. If bond prices start falling hard,
Right.
meaning yields are spiking, the bond market is screaming that inflation is coming or the economy is about to get too hot. That's a direct warning.
Wow.
Serious. The central banks will have to act, and that's when the stock market party gets shut down. The brains always move before the face.
Right, which brings us to the muscle, commodities, oil, gold, copper,
Yeah.
the real world stuff. How do they throw their weight around in this crew?
Well, commodities are the muscle because they represent raw physical demand and inflation. When commodities prices are ripping higher, it's like a tax on the entire economy. It costs more to fill your car, more to build a house, more for a company to make his widgets. And what absolutely hates inflation?
The brains, bonds.
Exactly. Inflation chews away at the fixed return you get from a bond. So you get this beautiful inverse dance.
Okay.
Commodities up, bonds down. It's one of the most reliable relationships in the game. If you see oil taking off,
Right.
your first thought shouldn't be, yay, BP shares. It should be, uh-oh, what are my bonds doing?
It's a domino effect then. The muscle, commodities, flexes,
Yeah,
which spooks the brains, bonds, which then eventually gets the face, stocks, punched.
you've got it. It's a chain reaction. And a lot of traders, they only see the last domino fall.
Okay, so that leaves the governor, the boss, the US dollar. Why does a currency on the other side of the Atlantic have so much say of everything?
Because the entire global system is built on it. The most important commodities, oil and gold, are priced in dollars. So if the dollar gets weaker,
Right.
you need more dollars to buy the same barrel of oil. Simple as that. The price of oil goes up in dollar terms.
So weak dollar, strong commodities. That's a clean inverse relationship.
Clean as a whistle. So if you see the dollar starting to look a bit peaky, you should expect the muscle to start flexing. And as we just said, when the muscle flexes, the brains get nervous. See how it all links up?
Yeah.
It's a web. You pull one thread and the whole thing shakes.
So practical play. Let's say I'm looking at the FTSE 100 and it looks bullish.
Yeah.
Chart looks great. What's my cross check? What's the intermarket health check I need to do before I risk my hard-earned cash?
Perfect question. Before you press that buy button, you glance at the rest of the crew. First, the brains. Are bonds stable or are they in a nosedive?
Okay.
A nosedive is a red flag. Second, the muscle. Are commodities prices calm or are they going ballistic?
Right.
Ballistic is a red flag. Third, the boss. Is the dollar just chilling out or is it making a crazy move that could disrupt things? If the rest of the crew is calm and confirming your move,
Yeah.
you can trade with confidence.
But if you see divergences, if stocks are screaming buy,
Yeah.
bonds and commodities are screaming sell, that's when you have to be street smart and listen to the crew, not just the loudmouth.
That's the entire secret. The divergence is the warning. It's the market telling you that the flashy story in stocks isn't built on solid ground. Ignoring those warnings is how you blow up your account.
Brilliant, mate. That's the kind of clarity we need. This isn't just theory.
No.
This is practical, a map for navigating the chaos. Right, everyone listening, you heard the man. This is how the big game is played. If you want to chop this stuff up with us daily,
Yeah, come on.
see these relationships play out in real time and have a bit of a laugh while we're at it, you need to be in our chat group. The link's down below. Hop in and have a laugh with us. Now, here's a question we'd like you to think about. The classic relationship is that rising commodity prices lead to fall in bond prices. But in a world of massive government stimulus and central bank intervention, can that relationship be temporarily broken? And what would it look like if both commodities and bonds started rising together? What kind of weird world would that be signalling? Have a think on that. We'll see you in the chat.